Good morning. Welcome to Stock Market. Today it's Monday, June 1st, 2020, and I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me on Twitter. I'm at Dan_Russo_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where we get a lot of the content for this show, as well as give you daily stock ideas to consider. And those hit your inbox every trading day before the market opens. So U.S. equities were mixed in Friday's trading, ending near the best levels of the day. The bullish thesis continues to center around the reopening of the economy and the hope for a COVID-19 vaccine, which comes on the heels of massive fiscal and monetary stimulus. Now, tech, healthcare, and utilities outperformed. Energy and industrials lagged. So a little bit of a reversal of that cyclical rotation that's been playing out over the past week and a half, 2 weeks. Treasuries were stronger with the curve flattening. The dollar was weaker against the euro. It's a continuation of a trend that's been in place now for a week as well. Stronger on the yen cross. Gold was up 1.5%. WTI crude was down a little over 5% on the day. And as we kind of get in here this morning, a little bit of a tumultuous weekend, if you will, with protests in a lot of the major cities around the U.S. And that has Dow S&P futures under pressure, about 30 basis points here this morning. It's on the heels of, kind of one of the better monthly performances in May for the S&P. So sort of give a little bit back here in what is traditionally a weak month for the market as well. June, based on data on the S&P 500 going back to 1950, tends to be one of the weaker months of the year. Now, Asian markets were higher overnight, led by Hong Kong, which was up more than 3%. And European equities are seeing some gains as well. Treasuries are slightly weaker. The dollar is weaker on the major crosses. Gold is flat to down small, and WTI crude is down 60 basis points to kick us off on a Monday morning of a new month. Now, taking a look at the S&P 500, right? A little bit of volatile trade on Friday, but a rally late in the day after support at that 3,000 mark, at that 200-day moving average hold, right? So we're holding the break through the 3,000 mark here in the near term. Now, initial support is 2850 to 2950 on the downside should 3,000 give way, right? Below that, we have to start thinking about 2750, which is slightly below the rising 50-day moving average. Now, resistance remains in that zone near 3110. A break of that level would target the February highs. So the upside case has not changed. What's happening here is we actually have had opportunities to tighten up our downside support as moving averages have come into place and, as other key levels have been opened up, right? We can get to 2850 because it's the bottom of this gap here. We get to 2950 because it's the bottom of this gap here, right? So all of a sudden you create a support zone, which is higher than one of the support zones that we had been talking about previously. So we're moving support up, while resistance areas are roughly unchanged because they haven't been tested yet. In the near term, based on a 13-period CCI and a 3-day moving average of that CCI, we are overbought. Major markets are overbought. If I'm looking at the charts in Chaikin Analytics for the SPY, the IWM, they're overbought. Now, Chaikin money flow is flat to bullish here in the near term as we've been dancing with the zero line. So from a playbook perspective, not a ton has changed. I think that on any kind of pullback here, should one materialize, holding 2850 to 2900 keeps this uptrend off of the March 23rd low intact, and that's important for the bulls. So what are we writing about today? SPY and IWM enter the new month in overbought conditions. Treasuries continue to consolidate, and we think an upside resolution is likely. Gold is trying the patience of the bulls during some range-bound trade. We'll take a look at that. Near-term weakness puts the dollar at key support. That's in our note. We're not going to touch on that one here today. And futures point to a slightly lower open this morning. So for the major indices, from a power bar perspective, Dow was flat-ish on Friday, 3 to 10 bulls to bears there. S&P 500 adds a 0.5%, 89 to 119 bulls to bears. NASDAQ was an outperformer while the small caps underperformed. So there's, again, a little bit more of that reversal from the cyclical trade that we've been talking about. NASDAQ still with a bullish ratio, as are small caps when we think about their power bars. Now, bonds upticked, sending yields lower, and tech was your leading sector, and tech from a power bar perspective remained strong. 22 bulls to 9 bears there. So according to the Chaikin Power Bar, small cap stocks more bullish than large stocks. Major markets are mixed. And our stock of the day is actually the one that I highlighted in our note to clients that I wrote yesterday. Every now and then I write our big Sunday note. And yesterday I highlighted Activision Blizzard, ATVI, and you can see why, right? Bullish rating, strong trend, strong industry group. I gave you our checklist, which is a really interesting feature that we have at Chaikin Analytics because it frames up how we think about the world, right? And especially with stock selection. With the top 3 metrics being, what do you want to buy, right? What types of stocks do you want to buy, right? Bullish stocks leading the market and strong industry groups. Great. But from there, what about timing? When do you want to buy those strong stocks and leading industry groups that are bullish, right? Well, you want to buy them when they're oversold, and preferably when the overbought oversold indicator is oversold and beginning to round higher. You want to buy them when they're above their long-term trend line, such is the case. And you want to buy them when money flow persistency is strong, right? So that's the setup that we're looking for at the individual stock basis. Now, does that guarantee the stock is going to go up? No, you should always kind of be managing your risk and having a stop or risk management process in mind. But adhering to a setup like this, to me, increases the odds that you're going to outperform over time. So we're highlighting Activision Blizzard. Taking a look at our sector tracker now, movement of the major sectors over the last 5 days. Financials, top of the list, part of that cyclical rotation, as are industrials. And I guess I would call the REITs part of a reopening trade, if you will, right? Like a lot of the commercial real estate REITs and the mall REITs have gotten absolutely decimated, as you would expect, with nobody working and nobody shopping. I shouldn't say nobody working from their offices, right? Everybody's working from home. And what does that mean for the future of the office, right? Utilities, though, that's an interesting one to me because that one to me is speaking a little bit of defensive rotation. Materials, healthcare, staples, middle of the road, and your kind of risk on, right, alpha generating trades are lower, right? Discretionary, tech, and comms, along with energy towards the bottom of the list. Now, I mean, lower on a relative basis. All sectors are higher, excuse me, over the last 5 days. Hitting our industry in focus, biotech services. This is a hot topic now. Everyone's talking about the biotechs here in the near term, right? And a lot of that's centered on, vaccines and for COVID. But no denying the fact that this trend looks interesting, right? Over the past 6 months, it's outperformed the S&P 500 by 13%, 50 to 9 bulls to bears, giving it a very strong power bar ratio. And it's currently ranked number 4 of 21 subsectors, having moved down 3 slots over the past week. Now, names that are kind of interesting there, Alexion, ALXN, Akebia, AKBA, and Vanda, VNDA, all have very bullish ratings. And if we take a look at the fund, to me, this is an interesting setup here, right? Because XBI has a very bullish rating, 50 to 9 bulls to bear, strong trend above that rising long-term trend line, right? Bullish stock outperforming. The one thing I don't like, the one knock, is I don't like seeing bearish money flow on a product that's trading near highs, right? You can almost think of that as a divergence, right? Similar to any other indicators that don't confirm price action at highs and lows. There's a divergence that takes place. But the weight of the evidence is still with a bullish view on the biotechs, right? You can see the breakout through 100, right? Think of it as a breakout, a pullback that's held so far, moving towards an oversold condition. So to me, the weight of the evidence still supports being bullish here. But you got to be mindful, I think, of the potential, red flag. So as always, you manage your risk. Let's take a look at what's trending now. And I have to be honest, from a news perspective, company-specific news is starting to wane as earnings seasons wind down, right? So we're going to get back to being at the mercy of the macro, if you will. But one thing does pop out to me on the winner side of the board, thematically, without there being really much news. Regeneron had some news, right? They had some data on Friday, and they're hosting an oncology event virtually today, right? So that's Regeneron. But NLOC, right? This is Norton LifeLock, Citrix, and Cisco. To me, these are all security plays, right? These are all some level of protection slash cybersecurity plays. So that's kind of interesting to me, right? I have to start to think about what's going on there, maybe drill down a little bit further. But those three stocks being on the leaderboard, right? Cisco's a networking company, but they very much are involved in the security aspect of networks. So that's interesting to me. That probably warrants taking a look, but those stocks were strong. And that to me is a theme that I see that may not be readily apparent. Market access on the list as well, up 5%, nothing company specific there. Loser side of the board is a little bit of a reversal of the reopening trade with names like JW Nordstrom, PVH, and Harley Davidson, HOG. APA, nothing company specific to take 9% out of that stock. And DXC did catch a downgrade, right? So DXC was down 14% following a downgrade at JP Morgan on Friday. Let's dive into the charts now. Small caps hit resistance and are overbought. Here's the IWM. And the IWM is on a lot of people's radar screens these days because their strength has been a sign of broadening participation in the market. They're actually starting to outperform the market a little bit as well, or their relative strength is improving, right? Their relative weakness has been diminishing. Now, I'm not showing it here on this chart because I just kind of wanted to frame this one up a little differently, right? We rallied back into the lower bound of what was really a consolidation zone for most of 2019. Downward sloping 200-day moving average, right? And this whole little cluster here acted as resistance to the near-term rally, while that 13-period CCI moved into an overbought condition, right? And the blue line is the 3-day emerging EMA, exponential moving average of the CCI. Now, money flow here is bullish, right? And if we look at relative strength, I'm sure we would see that the relative weakness has been diminishing, but I think near term, you're starting to see trades into resistance. Now, how we act at these resistance zones, right, is important, right? So far, SPY has broken through a key resistance zone at 3,000 at the 200-day moving average. The Qs we know, right? Remember, go back to last week's show where I said that the Qs were struggling with that 230 gap, right? Look at the Q chart. I don't have it here today in the show, but the Qs are struggling at resistance, and now IWM is starting to churn at resistance, all while being overbought, all while June is a seasonally weak month for the market. It's in my note. It's not here in the show today, but you start to put the data points together. And that's playing out while treasuries, for me, this would be the spot for, something like IWF to start rallying again. iShares 7 to 10-year treasury bond ETF has basically, in my mind, been correcting through time. Right? You had this parabolic rally as fear gripped the market, and the safety trade was to own treasuries, right? So, you end up with a treasury ETF looking like, a NASDAQ stock with a parabolic move, right? And then you get this volatile consolidation that settles down into a consolidation through time, giving the 50-day moving average time to catch up. If treasuries are going to work, I think this is going to be the spot where they break out from here, right? Overbought, oversold, kind of moving higher, money flow turning bullish. If they're going to work, they're going to work from here, and it's going to coincide with equities hitting resistance, with seasonal weakness playing out. You start to connect the dots and see the potential higher probability trades. And even something like gold has been consolidating throughout most of April and May. If this is going to work further, right? If we're going to get a breakout now, this would be the spot above the moving averages, right? CCI rounding higher, money flow turning bullish. This would be the spot. Have a great Monday, everyone. If you're interested in taking us for a test drive, you know the site, I'll be back tomorrow.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.